Welcome back to the Johnson Wealth Advisors podcast. Back again with Max.
How y'all doing? Good to see you again.
He took a little hiatus, but thanks for coming back.
I was sick, man.
So we are out here at the wonderful Evergreen Golf Club here in Tacoma, where we work on our game, and more so, Max coaches me on how to be better.
And business deals.
and business deals, of course. So today, with the stuff going on in the world, just here over the last few days, figured it'd probably be good to talk about volatility.
Market volatility,
man. This is something that really separates people. I list out my clients in 3 different ways based on how they deal with volatility. I have the oh crap. Okay. I call those people first. Try to talk them off the ledge when stuff happens.
Just be cool.
Right. And then there's the oh yeah. They are saying, hey, this is an opportunity. The market's on sale. I believe I looked at it before we left, like 13%. It's a little 13% clearance sale. Okay. And then you got the people that say, oh, well, they're just going to cruise, ride the wave. And I'll call those people last because I know that they're okay.
I feel like that's me. And the best investing advice I think I read from Warren Buffett was everyone's an investor until a bear market appears. And it's true.
So what else did he say? I posted something earlier this week. Be greedy when others are fearful, and be fearful when others are greedy. We love to hear those things and take the advice, but I can tell you I get a lot more calls when the market is down. And those calls that do happen, even though I try to be proactive, reach out, do stuff like this. Like I'll have the call next week. I'll have some friends from Franklin Templeton joining on the Zoom call, and they're going to give their presentation, Anatomy of a Recession. It's called Anatomy of a Recession, even when the market is good. So we talk about that, but that's just what they call it. Okay, great.
Well, and you're talking about from different perspectives, right? The S&P 500 could be good, but NASDAQ could be bad, or equities could be bad, or commodities could be bad. It's all a matter of perspective, right? What you're looking at.
So as y'all can see on the video, we got some papers spread out. These come from my partners that I work with, some from Russell Investments, some from Symetra Annuity Company. This is just to be able to give some statistics to go along with the feelings. Okay. So it's wonderful to feel. We all have to have feelings. My wife, I get in trouble with her because she says I don't have feelings. So it helps me out in the job, but
you're human, Elvis. Remember,
it's not so good when it comes to working with your spouses. So remember that one. So what does this stuff look like? And just to kind of give a little start. Okay. So bull markets, the way I had to remember it is when the market goes up, that's a bull market. Because the bull gets the horns. If you ever get flung by a bull,
he's throwing you up.
Okay? Bear market's going down because the bear's going to pounce down on you. That's the way I had to remember it when I was learning all this stuff. But hopefully that helps somebody out there. So bull markets and bear markets. And for those who might want this stuff, this is available. I'm just going to kind of show it like this, but it's all available. This comes from my friends at Symetra. This is what they call client-friendly. Client-facing information. There's plenty of disclosures that are out there. But what this shows us is that a bull market lasts on average of 4.5 years, 4.4 years.
Really?
Okay. And it goes up 149% in that time period.
In that 4 year span?
These stats go from 1957 to the end of 2024.
Wow. So that means in every bull market, you're getting about 50% of your worth gain, right?
Well, average.
Average.
Because again, just to point it out, what this was here most recently from 2009 up until it counted the 2020 COVID dip, even though it didn't last a full year. It counted that. But just in that time period, that was 11 years, and it went up 400%.
Wow, that's a really long bull.
400.5 just to be exact. Since I'm reading from some stats, but that's a really long bull market, right? Then we got one
right here.
5 years at 101.5%.
What was that for?
That was
dot-com bubble?
Between the dot-com bubble and 08. Okay. And then we had the 90s where we just had an amazing run. Okay. In the 90s, they didn't know what volatility was.
A lot of people made a lot of money in the 90s.
Oh my gosh. I mean, years of 20% back-to-back gains, they don't happen very often. Well, we just had that in 2023 and 2024.
Wow.
To have a third year in a row, it's not very often. Well, the 90s had it 4 years in a row.
Oh my goodness.
Okay.
Oh my goodness.
In the 90s, whatever year this works out, I think, again, it's not specific on the years in here, but it runs from, I believe it's from Black Monday in 87 all the way through 99. So 12.3 years, it went up 582.1%.
Oh my goodness.
Okay.
But to your point though, those are abnormally long bull markets, right?
Those are long bull markets, right? Yeah. But we got to have the long, and then we also have the short. Like technically this one counted from 2020 to 2022. Yeah. 1.8 years at 114.5.
That's a lot of market gain in less than 2 years. Okay. Wow.
So we've been talking about all the good. Everybody loves the good. Mm-hmm. Okay. But how do you feel when in a year and a half you go down 36.8?
Yeah.
How do you feel when 08 happens again, and in 1.4 years, you go down 56.8.
Yeah.
Okay. Or 1.1 months, hello, COVID.
Yeah.
You go down 33.9.
That was a rough time. I remember that.
Okay.
And here's the other thing that I think it's important for people to remember. Going down, you have a maximum of 100%. Going up, you don't have a maximum, right?
Right.
So going down, the impact is more. And I think that you and I had actually talked about this, right? When you lose 10% of your value, it takes double the amount of percentage to get that back.
Yeah, I mean, right? Roughly. I mean, think about that. If you have $100, you lose 10%, you lost $10. You're down to 90.
Yeah.
Well, if you have $90 and you gain 10%,
you're at $99. Right. Yeah, so you're not gaining it all back.
Right. So you got to earn more. And so some people like to play better defense.
Yeah.
And that's the best offense. The 2000 Ravens or just for around here, Legion of Boom.
That's right. Okay? That's right, baby.
So, and that's all well and good because, like we talked about the ups, there's not a whole lot. While the green on here, the green is showing the negative. I mean, it just happens to be Seahawks colors too, actually. But, they happen. But they happen, 3.3 months and 33%? That was 87. Mm-hmm. 48% down in 1.7 years. That was in 72. Okay.
Oh, yeah.
Mm-hmm. But also, you're not, I'm not going to have people fully invested 100% in the market.
Yeah.
So you have the bonds that are there to be your brakes, mm-hmm. that are there to counteract these things.
Yeah.
And now in 2022, that was a real bad year because bonds are inverse to stocks. Stocks go down, typically bonds are rising.
Yeah.
Okay. I know I probably should have did that like this for the camera, but the relationship with bonds to interest rates, when interest rates rise, bonds fall.
Yeah.
So 2022, we had a time where stocks are going down, so bonds should be going up, but also rates are going up, so bonds are now going down.
Yeah,
now we have our stocks and our bonds going down.
Yeah.
And it's like our brake lines just got cut. What the heck is going on?
I actually read something today about that, and I still don't understand that a little bit. They were talking about the inverse relationship between bond yields and bond pricing, mm-hmm. right? Which bond yield is just the interest that it's giving you on the bond, right? So I don't understand how those are inversely related.
Well, that's going to definitely be a whole nother episode. But
yeah, you're right.
The thing around that, just to kind of note, is if you have a car loan mm-hmm. and it's at 2%,
yeah,
okay, and rates have gone up now, are you going to refinance that loan to a higher rate?
No.
So why would a state? Why would a city?
That's a good
or a company that maybe doesn't want to issue any more stock but wants to get a loan, doesn't want to get a loan from a bank, will issues bonds to build their building. Why would they refinance their debt to pay a higher rate?
That makes more sense because I remember hearing something about that today. You were talking about the inverse relationship between stocks and bonds, and stocks were going down, bonds should have been going up, but bonds were also going down. Now,
bonds are going down because rates were going up.
Yeah.
And so now no one's going to refinance those rates with higher rates. I mean, think about our houses. I got my house at 2.69. I am not rushing to refi onto.
You'll probably never leave that house.
Right. So it's once we kind of take it out of the abstract world of finance and say this is what it is for us. So
that's a good point.
Speaking on timing, I know I posted this for those who follow me on socials. What is it? Johnson Wealth Advisors on Instagram, on Facebook.
Yep.
I can't time the market. So this was out there a little earlier this week on timing of the market. Now, I know you kind of glanced at this before we started. What this page shows is 10 years, ending December 31st, 2024, and starting out with $100,000. All the investments examples always start with 100 grand.
Yeah.
100 grand, 10 grand, that's just what it is.
Yep.
Missing the best 30 days over 10 years, your 100 grand now drops or only goes to 104,701.
Which this is for the audience that's listening at home. This is really, really impactful, right? So this is saying 10 years of investing ending in December 31st, 2024. So from January 1st, 2015 to December 31st, 2024. If you missed, so 10 years, that's 3,650 days.
For the mathematicians out there,
For the mathematicians and the people that want the numbers, right? 3,650 days. If you missed the best 30 days, that's less than 1% of that time frame. You only got basically a 5% return. 104,000. You only made $4,701 in 10 years.
And this is why when we get calls about, hey, what do I do? Should I go to cash? The answer is vastly no.
Yeah.
Now, there are some cases where, hey, I need this, money in a few months.
Yeah.
Well, we're not going to be in the market anyway.
Yeah.
But
exactly.
The answer is vastly no. Going to cash is not the solve. So I was speaking to a client Tuesday morning. We were talking about something that had nothing to do with this, and they asked about volatility.
Yeah.
And I said, we don't need to make long-term serious adjustments based on what could possibly be a short-term thing.
Yeah, that's true.
If it requires a Band-Aid, let's give it a Band-Aid. Let's not schedule surgery. Right?
It's a good way to put it.
So I said that, and they were like, okay, well, should I go to cash now? Because, and regardless of what you feel about, presidential politics, there's a great stat that's out there from American Funds. They show, and I know this is a little older, so I'm not going to give the exact numbers, but they show what happens. Presidential election, wait 10 years.
Yeah.
$10,000 in, wait 10 years.
Yeah.
With every single president, we've made money.
Yeah, every one of them.
We've made more with a Republican by a slim margin, and we've also made the least with a Republican by a slim margin.
Yeah.
So it's like your politics. What I tell people, your politics are in your car. You can get them on the way out.
Exactly.
Well, now that we're in a Zoom world, I don't know. Your politics are at your house, but
I think that's a good point. Politics don't really matter in the stock market if you talk about it from an investor's perspective, right?
In the long term.
In the long term, no one's out here being Warren Buffett. Like, it's very, very hard to be a good active trader, and a good active trader of the millions that are out in the world, I'd say less than 1,000 of them are actually good at what they do, and those guys are billionaires.
There's I don't remember the exact book, so I won't try to quote it and mess it up. But basically, it says, why does the individual investor not do well? Why, when the market gives us returns of 10.5% on average, does the individual investor's return be less than 4%?
Yeah.
And that's because of emotional behavior.
You're talking about, is that The Intelligent Investor by Ben Graham? Oh, okay.
No. This one's a newer book.
Gotcha.
But a lot of books speak on that, and what I'm writing is going to speak on that as well.
Exactly.
Because it's just worth talking about.
Yeah.
My value is not in picking the right stock, or the right fund, or the right ETF. You'll make money, if you leave it alone.
If you participate.
if you're in the game and you just leave it alone. By the way, I said that 100,000 turns into 104. If you left it alone, that 100,000 turns into $342,526
in the same 10-year period.
Same 10 years,
which is crazy, right? So let's look at the rest of this chart. So if you miss the 30 best days, you basically make nothing on your money. If you missed the 20 best days, you only make 36 grand, right? That's a difference of $180,000, which is insane. If you missed the 10 best days, you still miss out on, what is that, $140,000 of earnings? That's crazy.
These are the well clients.
Yeah.
Okay. Now, there's a different sheet by other people. I try to make sure I get all these different places that'll, that way folks know I'm not a Russell Simmons only, or not Russell Simmons, or a Russell Investments only, or whatever. Right. So this are the ones by Hartford. And it shows, well, what if you put money in when the market drops by 8% or more in a month? What if you took money out What if you left it alone? And what if you put money in? And it's crazy to show it. It turns it again different time frame, so it's not 100% applicable, but it basically doubles the return.
Yeah.
I'll get the real numbers for it, but I want to say it turns 100,000 from January 1, 1980 till the end of 2022, if I'm not mistaken. It turns that 100,000. If you just left it alone, it's 800 and some change. If you took out 2,000 every time the market drops by 8% or more in a month, which has happened, which it happened last month. It happened last month too.
Yeah.
Now you're down to 400,000.
Wow.
Half of your return over that 40 years. Okay? Oh my goodness. But if you put in $200 or $2,000 every time the market dropped by 8% or more in that month, 1.4 million. And change, of course. Yeah. But it's those who are opportunistic, who can and who have the behavioral and emotional stability or maturity, whatever word you want to call it, you'll do better.
Time in the market beats timing the market.
Man, playing double dutch, this is not double dutch.
Yeah.
We don't have to sit there and try to, jump in. No, just get in.
And that's the other thing that I think is good to talk about for the listeners too, is that's exactly what dollar cost averaging is, right? I mean, that's the dollar cost averaging mathematically is the best way to do this. Like it's
So what that ends up doing is instead of buying all at once, you're buying monthly. So if you got $100 a month, $200 a month, that's what dollar cost averaging is for those who don't know. $100 or $200 a month, whatever amount that you can afford, you put it in every single month. So when the prices are high, you're buying your same $100 might only buy 3 shares.
Oh, I see.
Well, when the prices are lower, your same $100 buys 6.
Yeah. Okay.
And so what it does is over time, your average cost per share is lower.
Gotcha. That makes sense.
Now, that's the mathematical benefit. What's better to me is the behavioral benefit.
Yeah.
I'm saving no matter what.
Exactly.
I'm putting away $200 a month no matter what.
It's a habit.
It becomes a habit.
Yep.
And so now you don't get concerned and do the emotional roller coaster that people do. Well, the market's down now. Let me pull it out and go to cash. I'll wait until the market gets better. And so now the market's getting better. And you want to wait until the market gets better so you buy here.
Yeah.
And then it starts to drop and you get scared and you sell here.
And then you want to wait for the bottom.
Wait for it to get better again. You can't time it right, and so you buy here. So you end up buying high and selling low because of emotional immaturity. I don't know, not to say folks are immature, but that's
what you end up doing. It's emotional fear, right? I mean, a lot of people put everything that they have in the stock market, and rightfully so. You've got a lot of people saying like, hey, this is a system that works, trust the system. You have a lot of people that, not for nothing, but social media didn't help the investing community, right? You got people saying, oh, I pulled it out right at the top and bought right at the bottom. People, that's not normal.
Yeah, that's ask those traders and everybody that does it, how much did you lose as opposed to how much you gained?
Yeah.
And it just kind of is what it is. But
for everyone that has $100,000 plus day, they have $500,000 losses.
I memean, if we stay in the boat, we'll be okay.
Yeah.
I mean, that's what it boils down to. So I know we're probably getting close to time. I don't want to keep everybody too long.
Well, I think we've got a little bit more, but one of the things that I think is interesting, and I didn't know this until recently, is that there's actually a way to track the volatility of the market, right?
The VIX.
Yeah, the VIX, right? So can you tell me a little bit more about that? Because I had never seen that before.
So it's a volatility index. It's not perfect, but it's a marker, just like what's called an inverted yield curve.
Yeah.
There's various markers that go along, and so some of these markers will be talked about.
Yeah.
So I don't want to steal, the thunder from next week, but so some of these markers are going to be talked about. Okay. And again, some of these markers have been very good predictors. Some of them have not. I mean, the yield curve inverted and nothing happened. Yeah. And then, it went back right. Okay, fine. Yeah. And so the yield curve inverting is supposed to be a indicator of how long did it stay inverted. Okay, we got this many months until a recession happens.
Oh, I see.
The volatility index, as volatility grows, now that's an indicator of this. And so while one indicator alone is kind of nothing, you want to get a pattern of various indicators.
So I guess that's the important thing to say, is that they're not indicators of what's going to happen in the future. It's these indications have signaled what happened in the past, and that's what. Oh, okay, I see.
Because that's all we can study from.
Yeah.
My crystal ball is broken. So
Warren Buffett's.
So 9.52, I believe, was the day gain percent. I believe it was Tuesday this past week. Okay, the 8th. Yeah, Tuesday the 8th. I think it was. Again, I'll put it in the description if I'm wrong.
Yeah.
But that's what I said earlier.
That's Verna's birthday. So
well, that's what I said earlier. Happy birthday, Verna. I was talking to a client that morning. She was talking about, do we? And I said, no, we don't know what's going to happen, right?
Yeah.
A couple hours after we got off the phone, tariffs got paused. 9.52. Yep. It's the largest day gain since World War II.
Jesus.
Well, we don't know that except for when it's in the rearview mirror.
Exactly.
So we can't look back and say when these best 30 days were.
Yeah.
Until we go, oh yeah, that's when it was in 2024.
Oh, it was that one, and that one.
Right. Yeah. Will this be the best day in 2025?
You don't know if it's going to be next Friday or next Saturday
will that not? Yeah. Will that 9.5 be the best day of 2025? Maybe. Maybe not. Yeah. It might be the 4th best day. Yeah. We don't know. And those who get scared and go to cash will not know either.
Yeah. That's a good. That
is what it is.
Wow. Yeah, that's a good point.
So, but there are options.
Yeah.
So, because I don't want to have anybody on this roller coaster, because it is a roller coaster, as various things will show us. Flipping through these pages again, not trying to present a whole slide deck, but yeah, here we go.
Yeah,
here we go.
That's a good one.
This is a roller coaster. Now, this is the S&P 500, the growth of it since 1957.
Yeah.
If you catch the trend here from the video, it's trending in the direction we want. However, there are dips. Okay. So
this is a really interesting chart too. It shows what the dip is for, right?
Oh, yeah.
Cuban Missile Crisis, fall of Saigon, Iraq War, Black Monday, Gulf War, Iraq War, GFC.
Global financial crisis.
Oh, that's right, 2008. Yeah.
Little longer right there. But
MERS, Ebola, Zika, Chinese stock market crash, trade war. Wow.
And there's also another piece where Time Magazine has put in there the death of equities, or the Time Magazine headline, and how many times they said stop buying equities. But the
probably more than Time cares to admit right now.
But volatility is a thing.
Yeah.
Okay. And we have to get used to that. And it's a roller coaster ride. If you're gonna throw up, I need to know. Okay.
Get you a paper bag.
I mean, because in this case, if you throw up on a real roller coaster, you're getting me and everybody else on the roller coaster messy, right? Yeah. This is only your roller coaster, so you're only going to screw yourself.
Nobody else on it, right? With you. Yeah.
Well, there are options if I know that you're going to throw up with a drop of this much. And there are programs that are out there. I can't speak specifically on them.
Unless people give you a call,
they got to give a call because they're not right for everybody.
Yeah,
and so that's kind of that's my hesitation, because to say I don't want to talk product, but just know that there are things out there that can provide some buffers against loss.
Yeah,
against some loss, sometimes possibly against all losses of the S&P 500, if it's right for you.
Yeah,
it may not be right for you, because with buffer comes limitations.
Yeah.
If you don't want all the risk, you're not going to get all the reward.
Absolutely.
And for some people, that's okay. And for others, they want the smoke.
Yeah.
Pure and simple.
Yeah.
They with it.
Yeah.
And they just, you have to know that within you.
Every person is different.
I mean, you can lie to me and say that you want all the risk and that you're going to take it. No, just don't lie to yourself.
Yeah, yeah.
It does you no good to be on a roller coaster that is so big that now you're having problems sleeping at night.
Yeah. Yeah, nobody wants that, because at the end of the day, all this money, you can't take it with you.
Not a penny of it.
It's just a tool for your life, man.
Not a penny. I promise you, if you advertise that you're taking it with you, someone will dig that up.
Yep.
Just is what it is.
Yeah.
So
that's a good point.
But we just have to just be aware and be okay that you have a limit.
Yeah. Yeah. I like it. That's
be aware
advice.
that you got a limit, and don't lie to yourself.
Yeah.
So
volatility is common, and it will happen.
Volatility is 100% normal. It happens every year. And again, there's another sheet in here where we can show that even in great years, this year is a quarter in.
Yeah.
We might turn up to be up 20%. We don't know.
Who knows?
Probably look at this and kind of end with that, I guess, after I find it. But in every year, the market goes down. Yeah, there it is. So what this one shows is that pullbacks are there, they're temporary. The yellow dots are when the market has gone down. Yeah. The market has gone down, the market has gone down. It went down 12%. Well, it ended up 13.
Yeah.
In whatever year that was, 2016, I'm going to say it was.
Yeah.
It went down 27% in 09, and it ended up 28. What if you bought in when it was down 27 and you accidentally timed it right?
Yeah.
You know, again, timing the market, but it's usually on accident.
Yeah.
So volatility is normal. It's going to happen. We just got to learn to deal with it. You know, we got to take. You can't just have sunny days. We got to get some rain with it too.
That's right. That's right.
So
that's a good spot to end on.
yeah. So go ahead and please submit your questions. JohnsonWealthAdvisors.com. Contact us. There'll be a questions link there, or email Angela at JohnsonWealthAdvisors.com. Yeah, hit the like button, share this video with folks that may benefit from it.
Need it.
Dev to the max.
Max at devtothemax.com. Go ahead and reach out for all your website needs, man. I'm here for you.
And 253-356-8612. If you don't email questions in, give us a call. Angela will be happy to take that call. So, thank you guys.
Cheers.
See you later.
That was time.